On today's Mortgage Markets and More episode, we're going to take a look at where mortgage rates are, why they are the way they are, what's going on behind the scenes. We're going to explore what you need to make to buy in northern New Jersey, and then we're going to get into co-op lending. It's not condos, it's co-ops. And then we got a fun fact segment at the very end of the episode today. Let's get into it. Welcome back to Mortgage Markets and More. I'm your host, Peter D'Angelo from Rate. I hope you're all doing well and having a great week. We're getting a taste of spring here in northern New Jersey, and I hope it's not just a tease. I'd like some more of this, please. We're going to get right into our mortgage rate update today as per Mortgage News Daily Survey, and as of recording this episode, the Thursday morning before its release. Starting off with our 30-year fixed-rate mortgage averaging 6.82%. The 15-year fixed-rate mortgage is averaging 6.24%. The 30-year jumbo fixed-rate mortgage is averaging 7%. The 30-year FHA mortgage is averaging 6.22%. The 7/6 SOFR adjustable rate mortgage averaging 6.44%. And the 5/1 SOFR adjustable rate mortgage is averaging 5.99%. That last one's according to bankrate.com. Looking at the bond market, we're seeing a comparable analysis here. The 10-year yield is at 4.328% this morning. The 5-year yield is at 4.082%. And the 2-year yield is at 3.993%. All of those are up from last week, just a smidge, although it's been a little bit of a wild ride since between episodes. There's a lot of market activity that happens. We actually saw the bond market drop rather significantly, really start tickling the 4% range when it came to the 10-year bond, which saw some further improvement on interest rates than our sampling this morning. And those interest rates across the board are up slightly compared to last week, with the exception of the 5/1 SOFR adjustable rate mortgage. That is the same as the previous week. Why did all of this occur? Well, we had a lot of information that got distributed and announced between episodes. We talked and I gave the heads up on a couple of these items. So we'll start off with the jobs report. U.S. jobs report came out on Friday last week. That showed new jobs added of 151,000. That is below expectation of 170,000 jobs, and it's still above the prior month, 125,000, but that was a large miss. When that happened, we saw the bond yields drop significantly, and we saw mortgage rates drop quite a bit, showing a little bit of a crack in the job market. Reason why that's important for us is that the Fed is looking at the job market, and they're looking at inflation. If the job market shows some instability, could be more of a cause for them to cut interest rates. More on that in a moment. The unemployment rate came in at 4.1%. That's a slight tick up from the prior reading of 4%, and also above what the expectation was. We were expecting it to be flat. The analysts were expecting it to be flat. So now 2 data points showing us a weaker job market. Hourly wage growth was flat month over month. We saw 4% year over year wage growth on the latest reading. The prior reading was 4%, and the expectation was that that was supposed to grow a little bit to 4.2%. So 3 misses here in the job report. Now we look at the job openings. This is where the narrative started to change as we're kind of looking at this as a story unfolding in the week prior. Job openings came in at 7.7 million. That was higher than expected. The expectation was 7.6 million new jobs, and that was also up from 7.5 million in the month prior. So the job market, now we can say we have a mixed bag there. Even though there was some rather convincing data, there's some weakness happening in the job market. One thing that I'm not mentioning right now is the ADP report we talked about last week, which was a huge miss. So when we pair that with the fact that we had a slight miss on the United States Bureau of Labor and Statistics reporting on the job market, we had a picture being painted for us that the job market could show some signs of weakness. Trends are more important than individual data points. I'm going to say that again. The trend is more important than individual data points. The market reacts to data points. The Fed is going to look at trends. There's going to continue to be this dissonance, and that's why we're going to still see some volatility this year, because we need to see a clear path forward with stable jobs and inflation making progress. So let's talk about inflation. We got the Consumer Price Index, CPI report. That came out this past week. That came in with the following figures. Month over month, that came in at 0.2% price appreciation. That was better than the previous reading of 0.5%. Remember, the last reading we had in the CPI is what kind of roiled the markets a little bit because of that rather stark increase in inflation based on this report. The year over year came in at 2.8%. That cooled down from the 3% it was at the prior reading. Once that 3 handle was on that number, the market reacted pretty poorly, and there was a little bit of concern that inflation was going to start rearing its ugly head again. So now we're starting to see it's starting to come back down to where it was prior to that higher reading than most were expecting. Now let's talk about the core. Again, the core are the numbers for price appreciation excluding the volatile elements. Volatile elements being food and energy. And that came in 0.2% price appreciation month over month, slightly below the expectation of 0.3%. And the core CPI year over year came in at 3.1%. That is also down from 3.3% from the prior reading. So that core being hotter is something that gets paid attention to a little bit more because it's removing the more volatile elements. But what we can glean from this information is if our headline number, which is not the core, taking into account everything, saw 0.2% year over year difference from the last reading, and we see that reflected also in the core, we're knowing now that the core elements, the non-volatile elements, are what's driving the price, well, I would say a less accelerated price appreciation. That's the best way to say it. So we have job market, a little tricky to determine, and then we've got inflation, and inflation is showing it's working its way back down, but we had a little pop up. So we need to see trends. Some other things that are not tangible numbers that are having an effect on the interest rates that you're getting right now are trade policies and tariffs. With trade policies and tariffs, there's ramifications for that. With anything that you read in the news, headlines drive a lot of market activity. Any headlines about tariffs will start to reignite fears on inflation because tariffs very likely and statistically normally translate to higher costs for consumers. Higher costs for consumers means price appreciation. Price appreciation equals inflation. That leads us to the next point. More conversation has been happening about fears of a recession. We haven't talked about this in a while. There were a lot of people calling for a recession, and those voices became very loud for a while, and then no recession happened. And it didn't happen for a long time. I'm talking about maybe 2 whole years now from when people, and when I say people, I mean analysts and market experts were saying, hey, we could be heading for a recession here. Once that first started, it's been about 2 years and it has not transpired. Well, those conversations are starting to hit headlines again. All that has to do is get into the psychology of the traders, the psychology of the investor, and that could start creating an environment where we start to see a drop in the stock market, which we've been seeing, and a drop in the stock market typically and routinely leads to a flight to safety. And a flight to safety means people stop investing in riskier asset classes like stocks, and they move their money into bonds, which is more stable. You have a fixed return on the maturity of those bonds. So when that happens, people start to flood there. Then we start to see the bond yields go down, which has the domino effect for our interest rates, and our interest rates start to go down. Also, the inflation data, I'm going to revisit that again because we saw there's now a widening gap between the personal consumption expenditure and the consumer price index, particularly because that one outlier report we had, not the past one I just reported on, but the one prior for the CPI, consumer price index, that showed quite a jump in inflation compared to what the trend has been like. We didn't really see that in the personal consumption expenditure. So with the mixed reporting that we're getting, it's creating some more confusion and chaos for traders in the market, which is creating more volatility. Lastly, the Federal Reserve policy is still bearing heavy on the market and how interest rates are coming about based on the data and the news that's being reported. We have the meeting coming up for the Fed, and right now expectation is that they are not going to wind up cutting rates. But when we talked about the bond market, we talked about where those bonds are trading right now, the trading activity is indicating for us that we're seeing expectations of 3 rate cuts this year. I'm going to highlight this, especially for those first-time home buyers out there. This rate environment is very volatile still. Right now, even though rates have gone up week over week, it's still been an overall downward trend, and we're still lower than where we were 5-6 weeks ago. This means this is opportunity right now, and this opportunity may not last for long. So if you've had any thoughts about getting pre-approved or getting into the market to start shopping, or if you've done it before and you put it on the back burner, now is a good time. If you have the bandwidth and capability to start shopping, now is the time to start again to hopefully take advantage of this lower rate environment, relatively speaking, compared to where it was as we started out the year. The reason why I'm saying that right now is due to the fact that we are still seeing that if the market is expecting 3 rate cuts and the Fed keeps their narrative consistent and they do not make mention of any possible cuts, if they keep using the terminology, we're going to stay data dependent, we're not going to possibly see those rate cuts. As soon as the light of hope glimmers and dies out of there being more rate cuts this year, the market's going to start trading accordingly. When the market starts trading along the lines of not expecting rate cuts, interest rates go up. Again, I sound like a broken record, and I'm sorry, but it is so important when we look back at the end of 2024. We look back at the end of 2024, the Fed cut their interest rate by 1% and mortgage rates went up by a factor of about 0.75%. because the conversation about future cuts dwindled. So that's important to know. Moving along, we're going to go to our Did You Know segment right now. Oh, I'm sorry. We're actually going to talk about our exploratory idea. I got ahead of myself, and I really wanted to spend some time on this, talking about what you need to make to afford to buy in New Jersey. I was inspired, and particularly northern New Jersey on this one. I was inspired after reading an article that was going into median household income. And I'm thinking to myself, okay, median household income, let me do some research on this. What does that look like in the northern New Jersey counties? So everything I'm going to share right now is kind of a blend, a weighted blend of these numbers and this information, because to me, what's most helpful for you? Looking at what the median, our representation of average, median household income looks like, and what that translates to by way of buying power. And then we're going to make a very important point at the end. So let's start off. In northern New Jersey, based on the research that I performed, and this is the amalgamation of sources, this is Bureau of Labor and Statistics, New Jersey surveys, a handful of different sources, comes in on average. Now that I said this is an average of the median, so we're really kind of flattening things out here. It's around $115,000. So I wanted to use that to drive our analysis and research. What that translates to, if you have that, and then I also read another article that was talking about how much money the average American consumer spends on housing as a percentage of their gross annual income. And that comes in, and it ranges. And this, again, is coming from the U.S. Bureau of Labor and Statistics. It comes in between 34% all the way up to 50% of gross monthly income. So I figured, all right, if the median household income in northern New Jersey is $115,000, let's use 34 or 43% of that number, somewhere in the middle. And I'm using my guideline knowledge, knowing that, for qualification purposes, 43%. We're going to just use that. That is pretty high. Now, that doesn't guarantee approvability for a mortgage, but it can be. So I just wanted to make that highlight for you. But we're going to use 43% as our factor. So we're assuming now household income is $115,000 and 43% of that is going to go toward housing costs. What are the housing costs? They're outlined as your mortgage payment, principal and interest, taxes, insurance for the property, and then mortgage insurance, because I used a factor of a 10% down payment. In 2024, the average down payment for the U.S. homebuyer, first-time homebuyer, was 10%, was like 9.8%. So I'm rounding that up to 10%. So using that factor, that translates into a purchase range for the average, the median household income qualifier of $520,000 to $550,000. Now, what does that mean by way of loan amount? Let's go into the numbers for your mortgage here. That means 10% down, and I'm going to use like 525. So 10% down, 550 is going to be our number for this. 10% down, we're getting down to 495. So 495 is your loan amount. I'm using 6.75% as our interest rate. I know we just talked about the average, according to Mortgage News Daily, being closer to 6.8 range, but I'm just saying 6.75 because that is an average, and from what I'm seeing, that's appropriate for the current market. That leads us to a monthly payment for your mortgage of $3,247. Property taxes, I just applied a percentage factor that gives us a good representation of what property taxes look like in northern New Jersey. They vary from town to town, county to county. So that comes in at $866 a month. The homeowner's insurance, I did go a little bit aggressive on this because homeowner's insurance rates have been going up quite a bit. So I'm saying that's $147 a month. And then mortgage insurance, average, I'm assuming a great credit profile here with the 10% down. We're looking at $111 a month. And that brings us to a total monthly payment of $4,372 per month. That represents 43% of that gross monthly income if the household has $115,000 a year. Out-of-pocket closing costs, prepaids, all of that, I'm just going to give you an all-in number for that to give you an idea. And you're probably looking at $55,000 for your down payment, plus closing costs being in the neighborhood of around $16,500, plus or minus, depends on when you close in the month, depends on how much those taxes really are. But using these tax figures, we're just going to factor that in like around 3% of the price for our closing costs and prepaids. We're looking at around $73,000 plus or minus. Like I said, I'm using rough numbers here. So with $73,000 out of pocket and $43.72 a month, that is what it takes to buy. Now, what did I say at the beginning? I said we're going to revisit this. We're going to contextualize this data. We're going to understand. We're going to put this in action. Well, if median household income is $115 and the price point to qualify and be part of that demographic that you're using 43% of your household income to pay for your housing, that translates to that $520 to $550 number. For those of you who've been shopping, I'm going to take a pause and let you guess or let you say it out loud. Don't feel weird. Think about it. What's the most difficult and competitive price point to shop in northern New Jersey right now? I know the realtor professionals out there know. It's that 500 range, that 500 to 600 range. Now we know why. Median household income's driving that. This was my aha moment when I was looking at the data, so I hope you found this information helpful and useful. Moving along to our Did You Know segment today, we're going to talk about co-ops. Co-ops are a little bit of a different animal. We talked about condos before, and condos, you are purchasing a unit, which is that physical space in the development. You have an HOA cost. You have an association that's managing common elements. There's a master insurance policy covering the structure of the building outside of your unit, as well as maybe amenities and things like that. Co-ops are a little different. Co-ops, you're actually purchasing shares of the cooperative. That's what co-op stands for. It stands for cooperative. Shares of the business that is that property. And so that property gets taxed with one major tax bill. And your share of cost is based upon the size of the unit you're purchasing in that co-op. So it's a little different than condos because you're not actually owning necessarily that physical space. You're owning shares of the cooperative that are directly proportional to the size and the space of the unit that you are purchasing. That also has implications for what those fees are. One of the tangible differences between a condo and a co-op is the fact that your association fees, if we're talking with the condo language, translates to co-op fees. And the co-op fees actually include taxes and that master insurance. So you can kind of think of it this way. Your HOA fees, when you have a condo, are inclusive of the master insurance for the building and the structure and amenities and whatnot. With a co-op, your taxes are part of that number, as well as the amenities, as well as the master insurance for the building and all of the upkeep. So you don't actually have your own tax payment. You don't actually have your own tax bill when you have a co-op. You only have your co-op bill that's monthly for your dues that are due every month, which has baked into it a portion for your taxes. So that's one of the major differences there. There's a couple other differences when you're shopping for a co-op that I wanted to highlight. So co-op lending is quite a bit different, and it is a little bit more difficult to qualify in the sense that normally co-op boards, which are comprised of unit owners and people who run the co-op, are involved in creating guidelines that the co-op has for people who would like to own there. So if you're not purchasing a co-op with cash, there is very likely going to be implications from the co-op board with respect to what type of lending you can get. Now, on my end, I have investors that I work with here at Rate that offer lending for co-ops, and there's a range of different possibilities. By and large, you should be prepared for 20% down minimum. However, when it comes to the co-op boards, they may require you to have a 25% down. They may require 30% down. Why they do this is to ensure a certain level of financial capability for their unit owners. That could be some of the mentality. There could be any number of things. Some of it could be in reaction to, issues that they've experienced in the past. So they've tightened up the requirements for unit owners. So that means if you want to have share of that co-op, you may have to have 25 or 30% down. In addition to that, you need to get approved by the co-op board in order to purchase that unit. So we have our mortgage approval process. Think of that as process numero uno. We're taking care of the numbers, getting everything ready for your financing. But then, once all that's ready, there's a whole application and approval process outside of the process that myself and my team manage for you so that you have to get approved by the co-op board. So you may have to complete an application, pay a fee, actually present yourself and go to a meeting of the co-op board to be interviewed and be approved to purchase. Even if your financing is good, it may not mean that the co-op board approves you to purchase that unit. So that's something to be aware of. Now, there's some other things that could be implemented here by the co-op board outside of down payment. Sometimes co-op boards get so far into their requirements where they actually have their own debt to income requirements, where they will say you can't purchase here if your debt to income ratio is more than 40%. Meanwhile, on my end, I may be able to lend to you with a co-op loan for 45% DTI and 20% down. But the co-op board may say, no, we have a cap at 40% and 25% down as our minimum. So that's something to be aware of. There's also restrictions. When you purchase a co-op, you may not be able to rent out those units. They may not allow you to have renters. It may only be permissible to have primary residence occupancy. So that's something to check out. In addition, co-op reserves also must be sufficient to satisfy the co-op board and the lender. On my end, I may have reserve requirements for your qualification scenario. My reserve requirements may be different than what the co-op board requires. So we were talking about down payment. We were talking about debt to income. They may also require you to have a certain amount of money in reserve beyond what I may require as the person assisting with your financing. So there's quite a bit more intricacies with co-ops, but hey, probably thinking, all right, well, you're talking about a lot of obstacles and a lot of challenges. Is there a benefit? And the answer is yes. There could be a benefit to you buying a co-op from an affordability standpoint. if you happen to be in a position where you can put down the type of down payment that's required and you can get approved by the co-op board, then your monthly housing costs may actually be less. Now, there are certain co-ops that we need to approve as well. So you can think of it this way. You have your own finances that need to get approved to buy a co-op. Then you have the co-op board that needs to approve you. And then sometimes on our end, for lending purposes, we need to approve the co-op. So we're talking about 3 approval processes there. So the benefit, if it's affordability that's helpful, it's worth it. But if affordability is not really showing itself to you in purchasing a co-op, then maybe it doesn't make sense. But co-ops could be great. Some of the other non-tangible, like we're talking numbers, we're talking how the rubber meets road to purchase. One of the other things to consider is that co-ops normally have a good community because they're selective. And so having a good community could be a benefit that is not necessarily a tangible, but something that, if that's something that you desire, could be attractive and appealing and worth going through all of that process. That is it for our Did You Know segment today. And I thought, when I was putting together things for the show, I'm like, I think we're going to do the fun fact at the end. Just tag out the show with a little fun fact, keep it light, and then move along, give you guys the rest of your day and the rest of your weekend. So our fun fact today was that bananas can be used in first aid kits, and sometimes are. The reason being is that banana peels, in particular, have been used and utilized due to the nutrients and whatnot that's in it as bandages. And of course, it can help to soothe insect bites and burns. So when you're enjoying that banana, maybe don't throw out the peel, especially in the summertime. You get those mosquito bites and whatnot. Maybe using some of that banana peel on some mosquito bites and sunburn, maybe that'll be helpful. So there's your fun fact for today. I hope you found all this information helpful and useful. Feel free to reach out to me. Find me on socials. Reach out to me via email at peter.d'angelo@rate.com. I would love to hear from you. One thing I will mention, I neglected to talk about it during the show, and I'm going to highlight it on the next show, but I got a really insightful YouTube comment that we're going to highlight next episode. So stay tuned next episode, and it's a really good example of what I talked about last week, and an actual real-life example of what waiting to buy cost a homeowner. So stay tuned for that. It's going to be a good one next week. I hope you all have a wonderful rest of your day. Enjoy the weekend ahead, and I look forward to getting you an update next week. Make it a great day, and take good care.